Hello and welcome back to the Geordie Pig Investor channel. Today we're going to look into an exciting stock that's currently just dropped in price, and that is Pepsi. Is Pepsi stock a buy right now? What is Pepsi Co? Stock ticker PEP. Pepsi engages in the manufacture, marketing, distribution and sale of beverages, food and snacks. It's most famously known for its Pepsi drink product that has rivaled Coca-Cola for many years. On the pictures below, I'm showing you the different types of stocks that Pepsi currently owns. You can see the stocks it owns within America that are mainly sold there, but also worldwide. And then it actually has international brands that are sold mainly across over Europe. Some interesting points about Pepsi: it is based in the United States. It is part of the beverages industry, has a market cap of over 230 billion. It went public in 1919, has over 300,000 current employees, is on a massive dividend growth streak over 26 years, have a 5-year dividend growth rate at over 7% and a dividend yield at over 3%. Over the last month, Pepsi has actually been down over 5.6%, and in today's video we're going to have a look at, is Pepsi now currently buy, hold or sell? Pepsi's earnings call and fundamental analysis. In its latest earnings call, Pepsi Co reported a revision of its full-year organic sales growth guidance to about 4%, down from this earlier expectation of approximately 5%. This adjustment comes amid a softer US consumer environment. However, the company remains optimistic, highlighting strong performance in its international segment and recovery in Quaker's supply chain. Pepsi Co also noted ongoing productivity improvements and targeted reinvestment to bolster growth in the second half of the year. Overall, while facing a challenging consumer environment, Pepsi's strategic investments in productivity, marketing and innovation, coupled with its strong international performance, provided confidence in achieving its growth targets for the second half of 2024, and they remain optimistic to hit these targets. Fundamental analysis: some key stats about Pepsi. They do have a positive free cash flow at over 7 billion. They have exceptional 3-year revenue growth at over 7%, positive operating income at over 14.3 billion, positive gross profit at 50.4 billion, positive net income at 9.5 billion. They have good long-term solvency, high Altman Z score at 3.95, average debt to equity at about 1.88 currently, and they do have poor short-term solvency and a positive net debt at 30 billion currently. Free cash flow. This is the number a company has left after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow is going to have a massive impact on the direction a company may be heading, so it's very important that you want to be investing into a company that either has a growing free cash flow or has very healthy free cash flow numbers. PepsiCo has had a steady free cash flow over recent years. Usually you want to see a growing free cash flow in a company. However, they are growing their dividend at a very healthy rate alongside paying out over a 3% dividend yield, so I'm not as concerned about the free cash flow continually growing year on year. I'm actually quite happy to see the fact that they're rewarding shareholders by paying out that healthy dividend yield and at a very healthy rate as well. Their current payout ratio is at 73% though, which is on the higher side, as typically I like companies to be at under 70%, but due to the long-term reassuring numbers of their free cash flow and the fact that it's a very well-established company, it clearly operates with no issues at these payout ratios, and I don't see it as a major concern, at least right now. Obviously, if this payout ratio starts to get even higher and their free cash flow starts to dwindle further down, then you may want to think that it's a potential concern, and it might be that the company is not in as good a position as it is right now. But like I say, right now it still seems in a very strong position to me. Moving on, we're going to have a look at Pepsi's discounted cash flow. DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on selected operating models. Pepsi's current price is $168.53, and when plugging in a discounted rate at 7.1% and a terminal growth rate at negative 2.6%, we can see that Pepsi was valued at $94.54, being overvalued at 44%. When plugging in a discounted rate at 6.8% with a terminal growth rate at 0%, we can see that they will be valued at $143.12, being an overvaluation of 15%. And when plugging in a discounted rate at 6.5% with a terminal growth rate at plus 2.6%, we can see that Pepsi would actually be valued at $245.44, being undervalued by about 31%. I not only look at the DCF valuation, but then I also look at something called the relative valuation. The relative valuation is a method used to value a company by comparing it to its competitors based on certain metrics. The metric it includes is EV to revenue, EV to EBITDA, and also P ratios. These are the main three that I personally use when coming up with my numbers, but you can use many other metrics and you can swap them in and out. When plugging in my numbers for the worst case scenario, Pepsi is valued at $208.41, which would be an undervaluation of 19%. On the base case, they'd be undervalued at 24%, being worth $222.89. And on the best case, they'd be worth $238.83, being undervalued by 29%. Once you have these two valuations, we can then come up with something called the intrinsic value. You can get this by simply adding the two together and dividing by 2. The intrinsic value of a stock has been used for many, many years to calculate a stock and has been used by a lot of different investors throughout the years, which is why it's one of the methods that I like to use when valuing my stocks. Pepsi's worst case scenario would be worth $151.48, average case being worth $183, and on the best case scenario, they would be worth a massive $242.14. The final method that I look at when valuing a company is the Wall Street estimates. This is an average estimation of a public company's quarterly earnings and revenues that leads to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There are going to be multiple analysts for a company the size of Pepsi, and they're going to be analysing the company on a day-to-day basis, hence why I do quite like these estimates that are made by Wall Street. On the worst case scenario, we can see that they believe Pepsi would be worth $152.51, which is a 10% downside on the current price. On the average case scenario, they thought that Pepsi would be worth $186.79, which is an 11% upside on the current price. And on the best case scenario, they thought it would be worth $210, which is a current 25% on the price. Overall, Pepsi being worth $168.53. This now means after I get my three valuations, I can combine them together and come up with my final worst, best, and average case scenarios. On the worst case, Pepsi is worth $151.82. So with a 10% margin safety on this price, I'd be looking to buy $136.63. And with a 20% margin safety on this price, I'd be looking to buy $121.44. On the average case price, we can see that Pepsi Co would be worth $184.27. So with a 10% margin safety, we can see it would be worth $165.84. And with a 20% margin safety, we can see it would be worth $147.41. Finally, we've got the best case scenario, which they believe Pepsi would be worth $231.42, which means with a 10% margin of safety, we'd be looking to buy $208.28. And with a 20% margin of safety, we'd be looking to buy $185.14. What does this mean for Pepsi? Is the stock a buy right now? I think that Pepsi Co is a very good, reliable, established company. I class Pepsi as a premium company due to the fact that it's been around for so many years and has been so consistent with paying that dividend. You are likely to pay a slightly more premium price on these types of stocks. Having said that, the recent drop in Pepsi's price means the stock is actually at a slight discount. This company is dividend king, meaning it has paid and consistently increased its dividend for over 50 years. It also boasts extremely healthy, profitable numbers across the board and is currently at its lowest price to earnings in over 5 years. The company is about as reliable as they get if you are a long-term dividend investor, and I don't see them going anywhere anytime soon. With their current price being just under $169, and on my average case valuation with a 10% margin of safety, you'd be looking to buy this stock at close to $166. I see this company as potentially being a good position to buy right now, especially with the fact that I mentioned before it is a bit more of a premium company, so I'd personally be happy to pay a little bit more of a premium price. Having said that, I do like to stick to my valuations, and I always like to go with at least the 10% margin safety on my average case price when buying any sort of stock. Do you like the look of Pepsi's current price, and will you be adding it to your current portfolio? Or is it potentially already part of your current portfolio? I hope you enjoyed today's video. Please let me know of any other stocks you want to see a full breakdown on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.